Okay, so this is a fun one. Today we're going to talk about the 10 biggest money mistakes that doctors make. They say comedy is tragedy plus time. Well, today we'll test that out and see if we can laugh about it now. Yep. Over it. Yep. Welcome to Money Med School, where doctors come to learn about money. Today we're going to talk about the top 10 doctor money mistakes and how to avoid them. Okay, this is a fun one. I've actually got a list of the top 25 mistakes, but for the sake of brevity, I'm shortening it here to the top 10. Don't worry, I'm not just going to lay them out there. I'm also going to tell you how to avoid them in the first place, or how to pick up the pieces if you've already made them. The most important thing to know is you're not alone. We've all done a variety of these mistakes. NBD, it's how you recover.
Wow. I mean, that was close. We can laugh about it now. We're all right,
If you've ever seen Planes, Trains, and Automobiles, you know what happened right before this scene. Just in case you haven't seen it, here's what happened.
All right, come on. Let's go. Let's go. Put your window down. You want some? Probably drunk. You're going the wrong way. What? You're going the wrong way. He says you're going the wrong way. Oh, he's drunk. How would he know where we're going? Yeah, how would he know? Thank you. Thanks a lot. Terrific. Thank you. What a moron. You're going in the wrong direction. You're going to kill somebody. You're going the wrong way.
They say comedy equals tragedy plus time. Let's find out. We'll review this list of 10 painful lessons and see if we can laugh about it now. All right, without further ado. Okay, number 10. Your investments never actually grow, but you don't notice because you can't read the brokerage account statements. You think your money is growing because the balance is higher when you check every year. This one applies to you if you've had an advisor set up your investment accounts. So, maybe somewhere you read that you're only supposed to check your investment balance like once a year because it's supposed to be, boring and you're not supposed to touch it. Like if you only look once a year, then you won't be tempted to sell off all of your investments if the stock market crashes. Yeah, if we're being totally honest, you wouldn't even know how to sell an investment or what a stock market crash looks like, so it's not like you're tempted. So meanwhile, you check your account balance every year or so after spending 20 minutes on the phone with the brokerage to get into your account because you have no idea what the username or password is. And also, that's after spending almost an hour searching your house for that scrap of paper you wrote down the name of the bank on. And when you check, you see that the balance is higher than last year, so your investments went up, right? Well, not exactly. The total balance went up, but that's because of the contributions you made. The individual stocks, bonds, and mutual funds may have increased or decreased in value, but the losses are masked by the contributions that you're making, which are much higher than any growth. In order to tell if your investments are actually making money, you have to separate out the total contributions from the total amount in the account. It's not obvious on your brokerage statement. The way the brokerage statement is set up is to look like a balance sheet, which is an accounting document, but that's not the way we're used to looking at numbers, unless you're an accountant. You'll learn how to do this in Money Med School, not accounting. You'll learn how to see if your investments actually made money. In fact, the master spreadsheet automatically calculates this thing for you. Number 9, your financial advisor earns money off of your money even when you don't. Regardless of whether your investments grow or lose money, your financial advisor collects 1 to 2% of all the money in your accounts. So, your advisor is earning money off your money even if you aren't. Yep, that's the thing. They make money off your money when you don't, even when you don't. And because it's based on the total amount of money in your accounts and your contributions are increasing the amounts rapidly, the performance of an investment here or there doesn't really matter to an advisor since it's not likely to affect their bottom line. Number 8, you are afraid to make the wrong decision when it comes to investing, so you put it off. Meanwhile, your money depreciates neglected in your checking account. You're embarrassed that you don't know anything about investing. Honestly, you don't even know what a stock is if you had to explain it to someone. And you think you're the only one. Well, you're not the only one. Ask me how I know. When I started out, I didn't know what a stock was. I didn't know that investing was a 2-step process. Once you deposit money in the investment account, you then had to also select the investments. Otherwise, it was just cash sitting in a bank account. I didn't know how to do any of these things, but now I do, and it's easy. There's no shame in not knowing. Unlike in medicine, where your currency is measured by how many factoids you know and never ever being wrong or making a mistake. The number 1 reason people do not invest their money is because they are afraid. They're afraid of losing their money or of something else. The only guarantee, though, is that if you don't invest your money, it's going to lose value sitting in a bank account. Currently, money in a checking account earns 0.001% interest. Money loses 3% on average every year due to inflation. So, there you go. On average, over the entire lifetime of the S&P 500, the stock market has risen in value with an average annualized return of 7%, and that's accounting for inflation. Even if there is a bad year, your money will bounce back. Now, there's always a caveat that if there's a market downturn right before you need the money, it may not have enough time to bounce back. So that's when you adjust your investment strategy. But the bottom line is, do not put off investing because you're afraid. Recognize it for the mind trash that it is, and start with a simple total U.S. stock market index fund, ETF. You can always build from there, branch out, whatever you like, but at least your money is growing in the meantime. And you can check out how to do that in my other video called Simple Ass Investing. And the link is in the show notes. Number 7, you let your student loans sit in forbearance all during residency, only to discover that when you begin repayment, all the interest accrued during forbearance is added onto the principal of the loan. So now you owe more than you borrowed, despite being in repayment, maybe for years. This one hurts. It's called capitalization, and I think it should be illegal. It's essentially compounding working against you. I'm sure it's spelled out in the fine print when you take out the loan, but when you took out your loans, you didn't know what you were doing. None of us did, and so it was missed. Plus, you had to pay for school anyway, so you would have taken out the loan. If you'd known, maybe you'd gone into repayment earlier, but geez, how are you supposed to afford that during residency? If you graduated when I did, you were lulled by the low fixed interest rates on the loans, and there was no graduated repayment plan at that time. So repayment during residency was near impossible anyway. Nowadays, there's no more fixed interest option on your loans, and you've got to start repaying soon because the interest rates are so high. And now, because of that, there are income-based repayment plans. The thing is, the solution to this is now you've got your attending income. You can knock out your loans aggressively, even if they are at high rates. Or you can refinance, or a combination of both. Either way, you have the power to get rid of them. Number 6, your investments are all managed by an advisor, so you're invested in dog shit with high fees and you don't know it. Look, the goal of a financial advisor is to make money. Not all of them are fiduciaries, which means they legally have your best interests at heart. For advisors, being a fiduciary is optional. The way advisors make money is to manage as much of your invested money as possible because they get 1 to 2% of this money. And they also make money by selling insurance policies. Typically, these are disability and life insurance policies, either term life and or whole life. Assets under management, also called AUM, refers to the investments that your advisor is managing for you. So that means they select the investments in your account and they buy and sell these investments. If your advisor works for a particular investment firm, they will be inclined to invest your money in that firm's product. For example, if the person works for Fidelity and Fidelity offers a targeted retirement product, then they'll put you in that. The advisor gets a commission and Fidelity collects the fees for the product. Sometimes the advisor may work for a company that isn't an investment firm, but tells them what to do. It gives them a cookie-cutter investment plan that they can use for all their clients. Someone is selecting these investment options, but are they good ones? Well, not necessarily. Hopefully they're index funds, but a lot of times they're managed funds with high fees. A managed fund means that a fund manager actually selects the stocks that are part of the fund, with the idea that those stocks will outperform the market as a whole. A fund manager has to be paid, which means managed funds have extra fees. Eugene Fama won the Nobel Prize in Economics for showing that financial markets are efficient and stock prices are unpredictable. Therefore, even professional money managers can't predict which stocks will do better than the market as a whole. This means that actively managed funds do not consistently outperform index funds. So why would you pay more for managed funds if they can't perform better than a simple total stock market index fund? To take it a step farther, why would you pay someone else to decide which stocks, mutual funds, etc. to invest in? Either they choose managed funds that have no guarantee of outperforming index funds, or they choose index funds, which you could have done yourself. It's always important to know how an advisor is incentivized. If they're incentivized to sell certain funds, or if they get instructions from their company that tell them what to do, like robots. Number 5, missing out on real estate, crypto, and other ways to invest outside the stock market because all of your investments are managed by an advisor. You're not invested in real estate at all. You're missing out on the safe gains and tax advantages that real estate has to offer. You're also missing out on any investment that's not in the stock market, like private equity or cryptocurrency. Legally, financial advisors cannot help you invest outside of the stock market, which includes stocks, bonds, mutual funds, and ETFs. So that leaves a lot of opportunities on the table, the biggest one being real estate. You can actively invest in real estate by purchasing property and renting it out, or you can invest passively in real estate syndications, which are large groups of investors all contributing to buy one property. Technically, you can invest in real estate via the stock market with REITs, but these don't offer the same tax advantages as purchasing actual property. Plus, REITs generate a lot of dividends, so you want to make sure they're in tax-advantaged accounts like an IRA, not a 401k, because you're going to pay on those dividends. You're going to pay taxes on those dividends when you take that money out. Now, cryptocurrency, specifically Bitcoin, can't be handled by an advisor, and for many, this is a good portfolio option. Finally, other options include peer-to-peer lending and private equity investment options. These are right out for an advisor, but some of them might be good options for you. You'd never know. You bought a universal or whole life insurance policy, and now you're stuck paying a lot of fees for a product with little value. These products do come with lots of fees, and they take many years to gain value. Plus, they are lifetime products. You have to contribute to them forever. To get out of them, most people sell at a loss. Even if you break even, after years invested in something, your money should have earned, not broken even. So that's a loss. Because remember, the 3% depreciation in value every year from money that just sits there, plus the lost opportunity cost. You could have invested in something else that would have made you more money. Number 3, you bought disability insurance through an advisor instead of an independent insurance agent, and you've got the most expensive disability policy known to man. Every bell and whistle has been included because that's how the advisor makes money. They make money on insurance policies by loading them with expensive optional riders. A rider is an additional component of a policy that increases its costs. The more expensive the policy, the more the commission the advisor makes. It looks like your interests are aligned because, after all, don't you want to make sure that if you lose one eyeball to a fork prong accident, you'll get extra money, and even more money if it's 2 eyeballs plus 1 finger? This is really how the riders are written. But how likely is it that you'll lose 1 eyeball to a fork and a finger at the same time? A lot of these riders are unnecessary, but they are expensive. Some of the areas are even covered by your health insurance. And just a side note, the insurance we need the most, mental health, pregnancy, and short-term coverage, that is nowhere to be found in these policies. Why? Because it's most likely to be claimed on and therefore lose the insurance company money. Number 2, you assume that since you make a lot of money, you have enough, but you don't really know because you've never looked into it. Well, everyone knows doctors make a lot of money, right? And so, if you make a lot of money, you'll always have a lot of money. I mean, my bank account balance is positive, so I'm fine. I make more than my expenses, so I'm fine. Well, the only way to know if you have enough money is to know how much money you have. And that means knowing your cash flow. Cash flow is how much money came in and how much money went out last month and the difference between the two. If your cash flow is positive, you spent less than you earned last month. If it's negative, then you spent more than you earned. Just looking at your bank account balance won't tell you if your cash flow is positive or negative. You can have a negative cash flow and still have a positive bank balance. Knowing your cash flow makes you powerful because it gives you clarity and insight about your money. You'll know where your money's coming and going, its whereabouts at all times. That's a tremendous relief. Knowing your cash flow also gives you a clear idea of how to plan with your money. If your cash flow is positive, you've got to decide what to do with the extra money. You can't leave it in the bank, it'll just waste away and depreciate. Put it to work for you. What do you want in life? Put it to work doing that thing. This could include investing, buying something, going somewhere, doing new things, whatever it is that you want for yourself. If your cash flow is negative, then it's clear that your money plan will involve finding ways to make more money flow in and less money flow out. Maybe you get a raise. Maybe you do a side gig. Maybe you get a tax strategist to lower your taxes. Maybe you get rid of paid subscriptions you don't use. As always, our goal with money is to use it as a tool to create the life you want for yourself. We come from a place of abundance, not scarcity. So if your cash flow is negative, that doesn't mean it's time to beat yourself up and take away all your avocado toast. It means it's time to identify what money behaviors are not serving you and let them go. It's time to find new ways of working with your money that does serve you and doing more of those. We cover all of this in Money Med School, both the positive money mindset and the cash flow techniques. In fact, the personal finance system calculates your cash flow for you automatically, so you always know your money's whereabouts. Knowing your cash flow is like a low jack for your money. And finally, the number 1 Dr. Money mistake. You thought that since your income increased 5-fold when you graduated from residency, your lifestyle could too, and now you've got the debt to show for it. Yeah, no. Eventually you can have your Lambo, but not right out of the gate. You've got to get your loans sorted out and make sure your cash flow is positive your retirement is being saved for, and any other life goals are in progress. Then you can buy your Lambo. And most importantly, you've got to ask yourself, is your Lambo really your priority? If not, you can always rent one for $4,000 a day and take some selfies and videos with it. This is Shay, the humbled trader, and it's a still image from her hilarious Lambo parody video. I highly recommend you watch it. The link is below. So to recap, 10. Your investments never actually grow, but you don't know it. Solution: subtract your total contributions from your account balance. Number 9. Your financial advisor is making money off your money even when you aren't. Solution: stop paying someone else to do what you can do better. Let the Money Med School personal finance system get you up and running. Number 8. You are afraid to make the wrong decision when it comes to investing, so you put it off and lose money. Solution: get confident with learning how to invest. You can check out my Simple Ass Investing video. Number 7. You let your student loans sit in forbearance during residency, and you learned what capitalization is the hard way. Solution: as an attending, you can knock out these loans pretty aggressively. You just gotta have a plan. Number 6. Your investments are all managed by an advisor, so you're invested in dog shit with high fees, and you don't know about it. Solution: see number 9. You can invest your own money easily and way cheaper than an advisor. Number 5. Because all your investments are managed by an advisor, you're missing out on investments outside the stock market. Solution: learn your options: real estate, private equity, and cryptocurrency in Money Med School. Number 4. You bought universal or whole life insurance and now you're stuck paying for it. Solution: look at the costs and the potential gains and decide if it makes sense to cut your losses. Number 3. You bought disability insurance through an advisor instead of an independent insurance agent, and you've got the most expensive disability insurance policy known to man. Solution: call an independent insurance agent and ask them to review your policy for a better deal. Number 2. You assume that since you make a lot of money, you have enough, but you don't really know because you've never looked into it. Solution: learn how to master your cash flow in Money Med School. The personal finance system calculates all this for you so you can get the number you need fast and spend your time planning what you'd like to do with your money instead of pecking numbers into a spreadsheet. And number 1, you thought since your income increased 5-fold, your lifestyle could too. Solution: do you sense a theme? You can DIY a debt plan, or you can let Money Med School do it for you. If you found this video helpful, please give it a like and subscribe to the Money Med School channel. Ta-ta for now.